Hello and welcome to India Invest, where you learn about stock market investing and financial planning. In this video, we're going to talk about the top 3 financial blunders that retail investors make that can probably cost them lakhs or even crores of rupees in the final wealth that they build after years of painful and patient investing. Now, we all know the pain and the effort that goes into making a large corpus of wealth at the end of 30, 40 years of your investing journey, right? So you don't want the final wealth that you create to be much lesser than what you deserve. Now, you may or may not be doing these blunders, but it is worth noting them and making sure that you or anyone near around you doesn't make these mistakes. So let's begin. So the first financial blunder that a lot of people make, especially those who have a little clue about stock market investing, is ULIP plans. Now, ULIP plans are bought by a lot of people, and I don't blame them because there are thousands of people out there whose job is literally to sell you these plans. But these plans are not good. These plans are not good for our financial wealth. These plans are not good for your financial freedom. These plans are not good for insurance, and these plans are not even good for wealth creation. So let us understand what these plans are and why they are so bad. Now, ULIPs, that is unit linked insurance plans, is a hybrid insurance plan which provides life insurance plus opportunities for investment along with tax benefits. So essentially, ULIP is insurance plus investment. So the investor has the option of choosing where the premium that the investor pays is invested in a ULIP. So you pay the premium for insurance as well as for investment. So you can decide where you want to put this money. You want to put this money in a debt fund or you want to put this money in equity. That is decided by the investor. And your premium can be invested in equity mutual funds, debt funds, or a combination of both. Now, ULIPs are sold by agents. You may have met these agents, you may have even bought these plans from some of them, and they always say that it's just the best thing ever because it provides insurance and it provides investment, it has tax benefits, it has flexibility of investing. It's just the best thing that's ever created by people. But if you dig a little bit deeper, you will realize that this is a bad scheme. Now, let's understand why that is. Because the first most important thing is that a large portion of the premium that you pay goes for various charges like mortality charges, administrative charges, premium allocation charges, etc. Now, you may know if you invest in mutual funds that these funds have like an expense ratio of 1%, 1.2%, 1.5%, or 2% tops, right? So for every 100 rupees that you pay, 1 rupee or 2 rupee is taken by the mutual fund. But in ULIP, this is much higher. In the first year, you're probably paying 9 to 10% of your premium just for all of these charges. So that's where you make the first most important mistake, is that you are not even investing all of your money into whatever place you want to invest it in. So that's number one. Now, number two, ULIP plans have very low insurance coverage. A premium of 1 lakh may probably give you a cover of say 10 lakhs or 15 lakhs. That's it. That's all the cover that they provide. And they reduce this cover under the garb that you are also investing this money, right? So they take away your insurance coverage and then they say that we are going to invest that money into other places. But the problem is, the big problem is, even there you get low returns. ULIPs give returns of around 7 to 10%. The best ones, the absolute best ones, may probably give you returns of 12, 15% or something like that. But that's like the best case scenario. And more often than not, you will not end up with the best case scenario. So essentially what is happening is that you're paying a lot of money for administrative charges. You're getting very low insurance coverage. and you're also not doing that good with the investment part. So you're faltering even in the insurance part, and you're faltering even in the investment part. So essentially, what you are is a very famous saying, "Dhobi ka kutta, na ghar ka, na ghat ka." So what do I do then? So the first most important thing that you need to do is always separate insurance from investment. Don't mix them together. They are fire and petrol. Don't mix them together, right? So, but what about all those benefits that my agent was telling me that I'll get by investing in ULIP? Uh, he was telling me you have the opportunity for insurance plus investment. Yeah, well, then what should you do? Then take an insurance plan and take an investment plan. Take them separately, of course. Don't mix them. So buy a term plan and an index fund. That's the easiest way of investing. And what about all the tax benefits that he was telling me? Well, you can always buy an ELSS fund, or you can buy PPF if that's what you want. I mean, if diversification is what you want, get into PPF. Or if you want just tax benefits with good returns, buy ELSS funds. And what about the flexibility of investing? He was telling me that I can invest wherever I want. Well, you can do that even outside of ULIPs. Buy a flexi-cap fund or a balance advantage fund, or buy one equity and one debt fund. So you realize that all the benefits that you will get from ULIP, you can get all of those benefits in a much better way by buying separate plans. A term plan is where you're paying a premium of say 14 or 15,000 and you're getting a life insurance cover of 1 crore rupees. That's a lot. Compare that to paying a premium of 1 lakh and getting a cover of 10 lakhs. So please don't mix these two together. Now let's move on to the second financial blunder. Now this is something that 95% of people don't know, which is mutual funds. Many people invest in mutual funds, but they generally invest in the bad kind of mutual fund and not the good kind. So mutual funds are two types, regular and direct. So when you invest in a mutual fund scheme, the fund house charges you an annual fee for managing your money. This annual fee is known as expense ratio. Now, direct and regular plans are the two choices for the same mutual fund, the exact same mutual fund. You are investing in the exact same thing, only that the intermediary that you're investing it through changes between the direct and the regular plan. So direct plan is where you invest directly into the fund through the company's website or sites like Zero the Coin, ET Money, etc. Right? And regular fund is what you get when you buy the same mutual fund from a financial advisor or a relationship bank manager. So if you have a financial advisor who advised you to buy one mutual fund, he will probably give you a regular mutual fund. So a regular fund. Now, what is the problem with regular funds? Since these agents need to be paid a commission every year until you stay invested, regular plans have an additional cost for the fund house. This higher cost translates into a higher expense ratio and consequently lower returns for you. When you invest in regular plan, a part of your gains are taken and paid to the agent as commission. So let's understand this through an example. Now, see, as we saw, a regular plan will have a bit higher expense ratio. So the mutual fund itself has an expense ratio. That expense ratio goes to the fund house, the people who are actually managing your fund. But when you buy a regular plan, what happens is that on top of this expense ratio for the fund house, there is an additional expense ratio for the financial advisor who advised you or who guided you into this fund, who sold you this mutual fund. So, say for example, we have this very simple mutual fund. You are doing a SIP in that mutual fund of 6,000 rupees per month. Now, the regular plan of this fund has an expense ratio of 2%, while the direct plan has an expense ratio of 1%. Now, you would think, oh, if I'm paying 6,000 rupees, the direct plan will charge me 60 rupees and the regular plan will charge me 120 rupees. Now, why should I take so much hassle for just 60 rupees? Now, here where the power of compounding comes into play. Now, imagine that the annualized growth rate of this mutual fund is 15% and you're invested in this fund for 25 years. Now, maybe this 60 rupees per month sounds very small at the beginning when you're investing, but when you will have put your hands on the final wealth that you create at the end of 25 years, you will probably start crying, because the regular plan creates a corpus of 1 crore 20 lakh 53,000. And what does the direct plan make? 1 crore 45 lakh 62,000. So this 60 rupees per month actually eventually costs you 25 lakh 8,000 rupees, or a 17% reduction in the final wealth created. Right? So you realize that since compounding creates wealth, compounding in expense ratio will also destroy wealth. Now, when I wrote in the title of this video that you will probably save crores by staying away from these blunders, you would have thought that I was exaggerating. But here is the proof right in front of your eyes. I am not exaggerating. Imagine if you're investing 25,000 here instead of 6,000. You are probably actually saving crores of rupees. So don't make this mistake. So what should you do? First, do your own research or get advice from your advisor, but buy directly. If you want to understand mutual funds, there are a lot of free sources out there will give you a detailed understanding of each and every mutual fund scheme out there. So do your own research, or maybe even take advice from your advisor, but don't buy from them. Don't use that intermediary to buy. Buy from company websites. You go directly into the company. If you find a mutual fund that you like, then go to that website and buy directly from there, or from a registered investment advisor like ET Money, or use sites like Coin from Zerodha that help you buy direct plans. If you already have active regular funds, now this is the problem. You would be thinking that I actually have these funds running and going for the last few years, so what do I do now? Then maybe try redeeming them gradually. Don't remove all of your money together. Start redeeming them gradually and move that money into direct plans of the same fund. As I said, the direct plan is for the exact same scheme. So what you do is take the money from the regular one, go to the company website, start a new scheme under your name and put the money there. Don't put it in banks. Once you redeem them, please don't let it lie in the banks. Put the same money into the direct plan. You may have to make multiple accounts. That's true. The intermediary, the financial advisor will probably tell you that the benefit they are giving you is all of your investments will be on the same screen. It will be easier for you. You don't have to manage multiple accounts and all. And he's right. You will probably face a little bit of trouble now, but you have to think about the money at the end of the tunnel. Think of the light at the end of the tunnel. Do you want to lose those lakhs and crores of rupees for a little bit pain now? You probably don't want to do that. So you have the solution right in front of you. Please do the needful. Now, the third mistake that a lot of investors make is chasing dividends. Dividends are very, very lucrative, and there are a lot of people out there who buy stocks only because they pay good dividends. Now, let us understand if that's a good thing or not. So, dividend or growth stocks. So, what is the most fundamental part of investment journey? Why do you invest in a company? You invest in a company for its growth. A company that grows faster will appreciate your investment. The main reason companies pay dividends is because management cannot find better growth opportunities within the company to invest its retained earnings. So if they don't have a good avenue where they are sure of getting good returns on their investment, they retain that money, they retain their profits, and then they pass it on to investors. If a company pays a dividend equivalent to a 2% yield, management is essentially telling investors they can't find better investments within the company that will return greater than 2%. So it is always better to invest in a company that reinvests all the money that it gets as profits for its own growth. So when to choose dividend stocks? So if you're old or if you're retired, you want a passive income on your investment, then choose dividend stocks. They are a good option for passive income, especially if you don't have other income sources. So if you're young and you're already having a primary income source, remember that dividends are taxed. So the money that you get is actually getting taxed. So it's much better that the money that you get is kept with the company and the company uses that money for more growth. For a young investor, a growing company will create wealth. Chasing low return dividends can be a roadblock in your investment journey. Only because some PSU somewhere is paying you a lot of dividend doesn't mean it's good. It's probably paying you dividends so that it can keep you with them, otherwise you will run away if you look at their actual growth numbers. So don't chase dividend stocks only because they're paying dividends. That is not to say that you have to choose stocks that give no dividends. Many good companies which are fast growing also give dividends from time to time. They give a portion of their earnings to the investors, to make them a little bit happy, and then the rest of the money they reinvest. So fast growing companies also give dividends, but the main focus should be on growth. Never pick a stock or a company only because it is paying dividends. Pick a stock because it is growing, and if it's giving dividends, then that's a bonus. But don't treat the dividend as the most important aspect or the choosing aspect. So that's it. These were the top 3 mistakes that a lot of investors make, especially young investors or investors who don't do a lot of studying, who invest while looking at the TV or in the newspaper, who invest for price, not for the company. So if you are one of those investors or you know people around you who have done these mistakes, pass this video to them. Tell them what is wrong with these things. Please help people into saving money, investing it, and creating a lot of wealth. I think our country very much needs millionaires who have become millionaires from the stock market. And it's easy. It's not that difficult. You have to be patient and you have to avoid these mistakes. So thank you. And please tell me in the comments if this video was helpful and if you want more videos like these. Thank you. Have a good day.